Welcome to reporting ACA to the IRS, ensuring your company is ACA compliant. I'm Scott Hovis, your moderator. Throughout this session, please submit your questions using the questions field found on the right-hand side of your screen. All registrants will be provided with a recording within 24 hours of conclusion of this program. And with that, I'm going to hand the webinar over to Steptoe.
Good afternoon. My name is Lisa Zarlenga, and I'm the co-chair of Steptoe's tax group. I recently returned to Steptoe after spending almost 4 years at Treasury, where I served as the tax legislative counsel. In that role, I oversaw the preparation of regulations and other regulatory guidance and the preparation of the President's budget proposals for a range of domestic tax policy issues, including implementation of the Affordable Care Act. At Steptoe, I advise clients on tax policy issues with respect to proposed tax legislation and administrative guidance. I am also doing the type of work I did at Steptoe prior to joining Treasury, which includes a mix of structuring corporate transactions and tax controversy matters. I'm pleased to be joined by 3 of my colleagues, all of whom are well-versed in the ACA. Joni Andrioff joined Steptoe a little over a year ago. She advises clients on a range of employee benefits and executive compensation matters, including plan design and compliance issues, welfare benefit plans, executive compensation, and mergers and acquisitions. Joni has also been advising clients on compliance with the Affordable Care Act. Cameron Arterton is the newest member of Steptoe's tax group, having joined us in September from the Treasury Department. At Treasury, Cameron served as the Deputy Tax Legislative Counsel, overseeing the development of regulations and other administrative guidance on a variety of issues, but she spent a significant amount of time on implementation of the ACA. Prior to joining Treasury, Cameron worked on the Hill as Representative Lloyd Doggett's Ways and Means Counsel, focusing on tax, trade, and budget issues. Jenny Kringle joined Steptoe in July of this year from CalPERS, where she served as the Assistant Chief Counsel and then Acting Deputy General Counsel. Jenny advises both private sector and public sector clients on employee benefits and executive compensation matters, including in the context of mergers and acquisitions. Jenny has also been advising clients on compliance with the ACA. I figured I would cover a little bit of background before we jump into the substance of today's presentation. The Affordable Care Act imposes new information reporting requirements on employers and health insurance providers. These information reporting requirements help implement 3 significant provisions of the ACA. Section 4980H is the employer responsibility provision, which imposes a penalty if certain large employers fail to offer affordable health care coverage to their full-time employees and their dependents. Jenny will discuss this rule in more detail shortly. Section 36 Cap B provides a refundable premium tax credit to certain low-income individuals. And Section 5000 Cap A, which is the individual responsibility provision, imposes a penalty if individuals fail to maintain health insurance for themselves and their dependents. Now, the credit and the penalties are determined on a monthly basis, which presents obvious difficulties in a system that relies on annual information reporting and filing. The information reporting provisions assist taxpayers in reporting their coverage and in computing their premium tax credit, and they assist the IRS in implementing these provisions. Section 36 Cap B F3 requires the healthcare exchanges to report to the IRS and to taxpayers coverage that is obtained on the exchanges, and as well as advance credit payments. We won't be discussing this reporting requirement today, but it assists taxpayers and the IRS in determining qualification for and the correct amount of the premium tax credit. Section 6055 requires any person that provides minimum essential coverage to an individual to file an annual return with the IRS and to provide a statement to the covered individual. This reporting requirement helps prove that taxpayers met the individual responsibility provision and prevents them from being subject to the 5000 Cap A penalty. And Section 6056 requires applicable large employers to file an annual return with the IRS and to provide a statement to the employee. This reporting serves 2 purposes. First, the IRS will match it with reporting from the exchanges to determine if the employer responsibility penalty applies. And second, it provides information to taxpayers for claiming the premium tax credit on their return. If we could go back to slide 6. There are separate forms to be filed by providers of health insurance coverage, which those people file the 1095B, and applicable large employers, which files the 1095C. The forms used to transmit the 1095s are 1094B and C. And these transmit those forms similar to the way that the Form W-3 is used to transmit Forms W-2 to the IRS. Joni will discuss the ACA filing requirements in more detail in a little while. The filing deadlines for 2015 for the forms filed with the IRS, they are going to be due February 29th, 2016 for paper forms, or March 31st, 2016 for electronic filing. And then the statements sent to employees are due February 1st, 2016. Normally they're due January 31st, but that happens to fall on a Sunday in 2016. A failure to comply with the information reporting requirements may result in substantial penalties. The IRS has announced that it will waive penalties for 2015 for filers that make a good faith effort to comply with the reporting requirements. Cameron will discuss the penalties and the good faith exception in more detail. And then I'll talk a little bit about what alternatives there are if the good faith effort isn't satisfied. But before we get to these topics, Jenny is going to help us understand the complexities of the employer penalties under Section 4980H.
Thanks, Lisa. So my job over the next 15 minutes or so is to lay the groundwork for the discussion on the nuts and bolts of reporting and, of course, on the ways to avoid these penalties. But before we jump into that, it's important for anyone who's responsible for reporting, particularly employers, to understand what drives the need for reporting and what drives the penalties. The reporting we're talking about under the ACA is not fill-in-the-blank reporting. So unlike other contexts, W-2 and payroll reporting, in ACA reporting, the substance of what you report, the actual content and data, can trigger massive penalties. So let's talk about the penalty background, and I'm on slide 9. The purpose of the ACA was really twofold: to accomplish, to increase access to private health insurance, but at the same time maintain employer-sponsored healthcare coverage. And the way that the ACA does that is it applies a penalty on large employers that fail to offer coverage to substantially all of their full-time employees. And of course, part of the difficulty over the last 5 years or so in implementing the Affordable Care Act is all of the legal challenges. And I think that's made some in the employer community a bit lax in terms of getting ready for implementation. But now implementation is upon us. 2015 is the first year that reporting is going to be required for. And of course, as we move into 2016, the reporting is going to become even more difficult. Let's talk briefly about 4980H at the 30,000-foot level, and then we'll unpack all of these details. The nutshell is that a large employer has to offer coverage to substantially all of its full-time employees. And that coverage has to be affordable, and it has to provide minimum value. And if an employer fails to do that, it risks paying penalties. And that's really the thrust of this rule. And from here, what we need to do is unpack this rule and understand each of these pieces. Let me point out that this coverage has to be extended to dependents. It doesn't have to be extended to spouses, but it does have to be extended to dependents. So the first question you have to ask is, what is a large employer? A large employer is an employer with at least 50 full-time employees or full-time equivalent employees. So it could be an employer that doesn't look, smell, feel like it has 50 full-time employees, but when you count these full-time equivalents, you may get there. Now, a couple years ago, some were wondering whether you could slice and dice your company to prevent or avoid being a large employer. You know, the IRS thought this a long time ago in implementing retirement plan coverage rules. And there are control group rules, affiliated group rules that are really going to prevent employers from trying to divide the company up into smaller pieces and avoid ACA coverage. So you can't.
I'm sorry. Jenny, does that mean that I wouldn't be able to, if I were treated as a large, that I could avoid being treated as a large employer if I had, for example, 150 employees, but put them in separate subsidiaries, so that I had a separate subsidiary company that did clerical work, one that did sales, one that did shipping, one that did IT, and that none of the subsidiaries would have over 50 employees? Does that mean that I can't do that to avoid the limitation?
That's exactly right, Lisa. You cannot do that. So these affiliate group rules are going to, even if you were to break your company up in the way you've described, they're going to bring your company back together and connect all these pieces for purposes of counting your 50 full-time employees, right? So once you've determined that you're an employer with 50 full-time employees, the next question you have to ask is, okay, what actually triggers these penalties? And what's interesting here is that the penalties are not actually triggered unless at least one full-time employee is certified as having received a federal subsidy, meaning that premium tax credit that Lisa talked about by purchasing health insurance through an exchange. So theoretically, if no one on your workforce goes out and uses the subsidy, then the employer wouldn't be subject to the penalty. But before you get too comfortable, as you can see on the slide, really anybody that has a family income up to $97,000 a year would be eligible to go to an exchange and purchase coverage. So it's going to be really hard to avoid these penalties without making the offer of coverage if you're a business of any real size paying anyone less than $100,000. Let's talk a little bit about the types of penalties. There are two main penalties under 4980H. The first penalty, what we refer to as the so-called A penalty, that applies if a large employer fails to make an offer of minimum essential coverage to substantially all of its full-time employees. In 2015, substantially all means 70%. The IRS and Treasury gave some relief for 2015. And the thought here was that even employers that have some exclusions, some independent contractors perhaps that they've misclassified, in general, they're covering 7% of the full-time workforce. They're going to be able to avoid the 2015 penalty. But for 2016 and going forward, it's 95% of the full-time employees that have to be offered coverage. So that 95% standard, of course, is pretty high. There's a couple things I want to point out. It's the offer of coverage, of minimum essential coverage, that's required, not actual coverage. So you don't have to go out and force your employees to take the offer. You just have to make it. And the second thing I want to point out is that it's minimum essential coverage is the type of coverage that needs to be offered. And just to kind of link things up with what Lisa mentioned earlier about that individual responsibility requirement, minimum essential coverage, or what we often refer to as NACS, that's the type of coverage an individual has to have to avoid the individual requirement. So because these two requirements go hand in hand, it makes the reporting that much more important as well to link it all up for the IRS. Okay, quickly, how the 4980A penalty is applied. It's based on all of your full-time employees employed for the year, even those who are covered. The amount of it is, as you can see on the slide, it's $2,000, but it's applied on a monthly basis, so it's prorated, and it's multiplied by your full-time employee staff minus 30 employees. So it's because it's monthly, if you think about it, it's going to be a lot better to correct things quickly rather than letting it build up over the course of the year. So you want to act quickly if you find that there's a mistake. So if you look on slide 15 by way of example, starting in 2016 when we're at that 95% standard that I mentioned, an employer that has as few as 530 full-time employees, let's assume that employer fails to offer coverage to as few as 27 full-time employees. And that may be because some of that 27 were people who were accidentally misclassified. Maybe some of them, they didn't realize they were not independent contractors, or didn't realize they were not full-time because somebody wasn't tracking their hours correctly. Maybe a few of them were intentionally excluded. But with that, just 27 people, that employer could get hit with a penalty of $1 million. Now, that's not a significantly large business to be hit with a penalty of that size. And so that's to give you an idea of just how massive these penalties can be.
So Jenny, does that mean that if you fail to just give one employee an offer of coverage, it could result in $1 million penalty?
That's right. It's a cliff. And so you can see how easily it is to drive right off that cliff. You'd be fine at 26 employees, but when you go over and you go over even just by one employee, like you said, Lisa, to 27, it's going to trigger that potential $1 million penalty. There's no credit for partial coverage when we talk about this A penalty. Now, by way of contrast, what we commonly refer to as the B penalty, this 4980HB penalty, applies when an employer has offered minimum essential coverage to 95% of its full-time employees, but at least one of those full-time employees gets a subsidy, goes out and uses the subsidy to purchase insurance. So why would that happen, you ask? It's three reasons that may have happened. First of all, you may have failed to offer coverage to that employee. So you may have offered it to 95% of your full-time employees, but this individual was in that 5% and wasn't offered coverage. It's also possible that the person was offered coverage, but the coverage wasn't affordable, or that the coverage didn't provide minimum value. And we'll talk in a moment about what both of those concepts mean. So a large employer that's liable for the B penalty, at first blush, it looks like it costs more. It's $3,000 per employee. But unlike the A penalty, it only applies to those people who actually went out and used the subsidy to purchase coverage. So I think when we think about this B penalty, this is really what we conceptualized when the ACA was implemented. Because if you think about it, it makes a little bit more sense. The government is paying a subsidy because the employer didn't provide an adequate type of coverage, and now the company has to cover at least part of that government subsidy. So that's the B penalty. Now, for most employers who are providing some coverage, the B penalty is generally going to be lower than the A penalty. And that's because the A penalty is going to be based on your entire full-time employee, number of full-time employees minus 30, whereas the B penalty is going to be based just on those people where there was a failure to satisfy the rule. Before I talk a little bit more about minimum value and affordability, I want to distinguish between MEC and minimum value. MEC, minimum essential coverage, which you've heard me mention a few times, that's really there to avoid that A penalty. And it's to make sure that the individual avoids the personal penalty. On the flip side, that minimum value concept is there to avoid the B penalty. So just to avoid confusion between those two, I wanted to clarify. On slide 20, you can see the different types of minimum essential coverage. The one that's most relevant for us here today is really going to be coverage under employer-sponsored plan. Some folks on the call may have that grandfathered health plan, and that's going to count as MEC as well. In addition to being minimum essential coverage, the coverage has to be affordable. Now, the basic test here is that the premium can't exceed 9.5% of the employee's annual household income. Whether or not coverage is affordable is based on the cost of employee self-only coverage. And there are safe harbors that apply to make sure that you have coverage. And that's, of course, important because the only thing you really know is how much you're paying the employee. You don't know what the employee's other income situation might look like with a spouse, perhaps, or what sort of other business losses, incomes the individual might have. So you have these safe harbors in place that allow you to determine if the coverage is affordable. So as I said, the coverage has to provide minimum value, and it has to be affordable. The minimum value test, what that means is that at least 60% of the individual's health care expenses have to be covered, leaving the individual to pay the remaining 4%. This is what we call that bronze level of coverage, and it's the lowest level. So the coverage has to be bronze or higher in order to provide minimum value. And again, just linking us back to those penalties, that minimum value and affordability are there to avoid the B penalty. There's 3 options then in providing minimum value. You can use the calculator. There are safe harbor checklists, or you can actually get an actuarial certification. As I wrap up this part and we move on in a few moments to the nuts and bolts of the forms, let me highlight a couple top risk areas for these penalties. And I'll just go quickly through these. The first risk area is not counting hours properly. And as you can see, if you don't know who your full-time employees are, you're going to have a really hard time making an offer to at least 95% of them. So it's critical to have systems in place. You need to have something programmatic and systematic that counts these hours and ensures that you've got everybody flagged correctly in terms of the number of hours that they're working. The second area is failing to track full-time employees, and particularly when you have variable employees, people who are not working typical 9 to 5, 40-hour-a-week, all year long work schedules. Don't lose sight of those people. You have to track them to make sure that they're being counted as full-time employees if they are in fact full-time employees or full-time equivalents. Third, applying waiting periods incorrectly. There are some complex rules for waiting periods, especially when they're applied in conjunction with orientation periods. So you want to make sure that those are done correctly. Fourth, and I think this has been one that's been not on folks' radar as much as it should be, although I think that's changing, and that's failing to review your employee versus independent contractor status. Just like with basic labor employment rules, there's now new risks with the ACA if you don't correctly identify who is an employee and who is an independent contractor. A couple more, intentionally excluding too many employees. So there may be some employees that you decide have to be excluded that are going to fall into that 5% margin of error, but you want to make sure you still leave yourself some margin of error and you don't exclude too many people. Not making proper offers of coverage. The offer itself has to be meaningful. It has to be real. You can't do open enrollment on New Year's Eve and expect everybody to have made their decision on New Year's Day. It's got to be a real opportunity for employees to elect coverage. Excluding some locations, that's another risk. So you may have a location for your company where it's very difficult to provide coverage, and you just need to be very careful with that to make sure you don't go over that 5% margin of error threshold that I mentioned. And the last risk area we see is excluding dependents. You know, as we mentioned before, you don't have to make an offer to include spouses. You do have to include dependents, and so that's a significant change for some plans. So with that, let me hand it over to Joni now to talk about the reporting itself.
Thanks, Jenny. Okay, so Jenny explained the rules for why the IRS might be trying to collect all this information. And now our question is, how in the heck are we going to provide all this information to the IRS? Well, the Affordable Care Act instituted 2 reporting rules. One rule requires large employers to report to the IRS and their employees information regarding health coverage offered to the full-time employee that was implemented in a section of the Internal Revenue Code 6056. And the second rule requiring reporting is Section 6055. It requires large insurers, some self-insured employers, government-sponsored programs, and any entity that provides minimum essential coverage to report information to the IRS and covered individuals on enrollment. Lisa and Jenny pretty much went over the forms that are going to be used to collect this information. Basically, Form 1095B is the form that coverage providers are going to file with the IRS and provide to participants to provide enrollment information, and that form will be transmitted to the IRS using the transmittal form 1094B. Form 1095C is the form that employers are going to use to report their offers of coverage, and Form 1094C is the transmittal form for all those Form 1095Cs that are going to be reported to the IRS, filed with the IRS. We're going to look at Form 1095B, which is for the coverage providers, very briefly, just so you'll know what it looks like. We've already answered these questions basically. Who files coverage providers? What form is submitted to the IRS? Form 1095B using the transmittal form 1094B. And what form does the covered individual receive to report for tax returns, individual tax returns? That would be Form 1095B. And then what information is required? I think we've covered most of this. The covered entities have to report on information about the entity providing the coverage, the name of each individual enrolled in minimum essential coverage, along with taxpayer ID numbers, and the number of months that the individuals were covered. So here's the form. You can see in Part 1 the requirements for providing information about the covered individual, the individual who's enrolled. That would be probably your employee. The Social Security number and other information. Then Part 2 is the employer sponsoring the coverage and that information. And then the issuer or other coverage provider. And this would basically be the insurance company for an insured plan. However, even for a self-insured plan, if it was provided by a union multi-employer plan, for example, the trustees of that multi-employer plan would be the issuer here. Then here you see that where the information for covered individuals in Part 4 is provided, the Social Security number for those individuals, which is a date of birth if the social is not available, and the months that they were covered. This is just page 2 for more covered individuals. This is the information that's required that we just talked about. We're going to focus mostly on Form 1095C, which is the form that the employer files. Again, we've answered most of these questions. Who files? It's the employer. What form is submitted to the IRS? The form is submitted is Form 1095C using the transmittal Form 1094C. The form that the covered individual receives is Form 1095C unless it's possible to use the safe harbor, which we'll go over later. And the information to be required is the information that is required by the form. Let's go right to the form. The first part of the form is the employee information with Social Security number and the applicable large employer, as Jenny defined it, 50 or more full-time equivalent employers employing 50 or more full-time equivalents. Here's where that information goes in Part 1. Part 2, lines 14, 15, and 16, is where the information is provided about the employee offer of coverage. So that's line 14. Line 15 is where the employee share of the lowest self-only monthly premium is reported. And line 16 is a numeric code that explains whether the employer is going to be subject to a penalty. Well, how are we going to get all that information on just these 3 lines? Before we go to that, Part 3 lists the covered individuals of the employee covered by the employer's plan with Social Security number, if the Social Security number is not available, the date of birth, and then all of the months of coverage. There are special rules for the particular problem of obtaining or getting for your files the Social Security number for the dependents. That's not information that we've typically acquired over the years, but that information is required here, and there are special rules about employers asking for that information and the procedures that they use for asking. Here's a continuation. This is page 3 of the form. This is Part 3, more covered individuals. This is the information we just went over for your reference. Okay, we're going to go over a few examples of line 14, line 15, line 16. And these lines are completed by the employer. On line 14, we're going to insert an alphanumeric code that indicates the employee's and family members' eligibility for subsidies on an exchange. We're going to show the monthly employee contribution for self-only coverage, and we're going to insert on line 16 the codes indicating the employer's potential liability for the A and B penalties that Jenny just described. I'm just going to give you a look here at some of the alphanumeric codes if you haven't already taken a look at them. They're in the instructions to Form 1095-C. Let's look at 1B. 1B, if you use it, is going to indicate that the employer made an offer of MEC providing minimum value, but offered it to employees only. 1C is the same thing, but it was offered to dependents in addition to the employee, but not the spouse. 1D is the same thing, but it was offered to the employee and spouse. So there are different combinations here in the 1 series that will indicate whether the employee is entitled to a subsidy. Here's more codes. Okay, these are the alphanumeric codes for line 16. Line 16 will show whether the employer is going to be subject to the A or B penalty. 2A is employee not employed during the month. 2B, employee not a full-time employee, did not enroll in MEC. 2C, employee enrolled in coverage offered, etc. So you can see these codes are different combinations of how the employee is employed during each month of coverage. Just to recap who files, and I'm going to have you look at the gray box here. An employer with 50 to 99 full-time equivalents, even if they're exempt from the penalty in 2015, still has to make this filing on Form 1095-C. For an insured plan, such an employer would have to fill out on Form 1095 Parts 1 and 2, but not 3. And just going back to the form, Parts 1 and 2, that's just the employee information and the employee coverage information, but not this enrollment information. For an insured plan, just Parts 1 and 2. And the insurer or other provider of MEC files the Form 1095-B. For a self-insured plan, it's different. The employer does Parts 1 and 2 and is also responsible for the enrollment information in Part 3 because there's no other provider of coverage there. The rule is essentially the same for employers with 100 or more. So let's go over the examples that we've put together, and we've done our best to create some situations that you might face and try to come up with the correct codes. You may differ on some of these, but we're going to assume for purposes of these examples an employer with over 50 full-time employee equivalents with a self-insured plan that covers all full-time employees, spouses, and children, provides minimum value, and charges an employee contribution of $150 a month for self-only coverage. So here's our first example. It's John. John's a full-time employee. He has W-2 compensation of $25,000. So here's our example up here. This is Part 2 of Form 1095-C. Let's look at line 14. What offer of coverage did John receive? Well, we put code 1E for all 12 months of the year because in our example, John is covered for all 12 months of the year. 1E, as you can see down under the chart here, is minimum essential coverage providing minimum value offered to the employee and at least minimum essential coverage provided to dependents and spouse, because that's the kind of coverage we're assuming for our example. There's in line 15 is our lowest premium for self-insured for self-only coverage. It's $150. And down in section line 16, we're going to enter 2C. And 2C is the code for employee enrolled in employee coverage. So I'm going to use this example just to go over a question here. How come we can't use 1A, a qualifying offer, because our plan seems to have it all? We have MEC providing minimum value offered to full-time employees and at least 2 spouse and dependents. But we can't use 1A here because our coverage is not considered affordable for purposes of 1A. For 1A, the self-only coverage has to be equal to or less than 9.5% of the mainline single federal poverty line. Okay, and ours is not. For 2014, 9.5% of the single federal poverty line is, for a single person, $11,670, and that works out to the limit for the self-only coverage contribution would be limited to about $92. Our premium for self-only coverage is too high. It's $150. So we can't use 1A here. Now, is this coverage affordable for John? We're assuming he has a W-2 compensation of $25,000. So here we are using his W-2 compensation in the safe harbor for W-2 compensation. And if we work out 9.5% of $25,000, it works out to a self-only, the limit for self-only coverage, the premium for self-only coverage limit would be about $197 a month. So our $150 is less than 9.5% of John's W-2 compensation, so it's affordable for John. I'm going to move on here to the second page of John's example. Since our plan is self-insured, we have to check the box in Part 3 for self-insurance, and we list John and his dependents here. So John, John's wife, John's child, their Social Security numbers, and the fact that they were covered for all 12 months. Here we have example 2. This is Laura. Laura is a full-time employee who's eligible, but she's not enrolled. Maybe she has coverage elsewhere. We don't know why, but she's eligible but not enrolled. We're going to assume that her salary is at least $25,000 so that our coverage of $150 for self-only coverage is affordable for her. Again, we're going to enter on line 14 1E because we know our coverage is MEC providing minimum value to an employee and dependent and spouse. But the difference from John is here in line 16, we don't put 2C, enrolled in coverage. We're going to put here 2F because we use the W-2 safe harbor to prove that Laura's coverage is affordable. Now, why didn't we put 2F for John? Because it's the same, we use the same safe harbor. If you look at the instructions to Form 1095-C, it makes clear that wherever an employee is enrolled, 2C kind of trumps everything else. So since John was enrolled, we used 2C for him. This is Part 3 for Laura. Laura's not enrolled, so we don't list any enrollment. Example 3 is Jane. Jane's a little more complicated. She's full-time eligible, but she was not previously enrolled. But then Jane had a baby, and she special enrolled herself and the baby on September 15th. So we know for line 14, we have the coverage that is indicated by 1E. She had that for all 12 months, an offer of coverage for all 12 months. In line 15, we have our premium. Even if we assume Jane had made at least $25,000, we know that that is affordable. Now, line 16, what are we going to do here? Jane was not enrolled in coverage until September. So for the first January through actually September here, we're going to show that the coverage was affordable, that we used the W-2 safe harbor. The September 2F is in green because I wanted to point out that in order to use 2F, in order to use the 2C, I'm sorry, the employee enrolled in coverage, the employee has to be enrolled in coverage every day of the month. So because in our example, Jane enrolled on the 15th in the middle of the month, we can't show that she's covered for September. We have to show, we're still showing 2F, and then for October, November, December, we show her as covered. Part 3 shows Jane and her baby. We use the Social Security number for Jane. We use the date of birth for the baby. Actually, the baby should have been, we should have her as being born before the 15th. But we have her birthday because we don't have her Social Security number. And here we show coverage for September, October, November, and December. Even though we couldn't show coverage for September in Part 2, we do show enrollment in Part 3 for September, because the rule for enrollment is that if you were enrolled on any day of the month. So it's a little different. Okay, here's one just to drive you crazy. This is example 4, Cathy. Cathy is a new full-time employee hired in February, let's say February 1st, just to make it simple, with a 90-day waiting period for eligibility. And she transfers to time in September. I'm going to start this example by assuming that this employer, for purposes of determining who's full-time, used the so-called monthly measurement period. So this employer is looking at whether a person is full-time month by month. So here we see on line 14 for January that there was no offer of coverage for Jane, and we can tell in line 16 the reason. She was not employed during the month, so that was 2A. In February, we're going to show no offer of coverage, and we're going to show that for February, March, and April. When we move down to line 16, we can see that the employee is in a so-called Section 4980HB limited non-assessment period. And here, that just means the 90-day waiting period. So for line 16, for those months that she's in the waiting period, we list 2D because she's in a assessment period and she's not eligible for coverage. Starting in May, though, Cathy then does elect coverage as a full-time employee, so we're showing our coverage 1E. We made an offer of coverage. Our $150 premium for the employee portion of the self-only premium, and we're showing she's covered for May, June, July, and August. Now we have her going part-time in September, and in going part-time, of course, her hours were reduced. So in the reduction of her hours, she falls out of coverage, and she is then eligible for COBRA. So on line 15, on line 14, we're still going to show that she's eligible for our coverage, but now it's at the COBRA self-only premium amount, and this is not made explicit in the instructions to Form 1095-C, but this is our assessment that the COBRA self-only premium belongs here. Since she wasn't covered for the entire month, we list 2B She was not a full employee. She did not enroll in MEC, and she's 2B for the rest of the year. Now, just changing this example a little bit to a what if. What if, instead of losing coverage because she reduced her hours, she actually lost coverage because she terminated employment? If that were the what if, and those what ifs are marked by a question mark here on example 4, if she terminated, and it depends, this example depends on whether coverage terminates on mid-month and on her date of termination, or whether coverage continues to the end of the month. But when she terminates employment, we're going to show her as no offer of coverage. Whether we list the COBRA premium here or leave it blank depends on whether coverage terminates mid-month on termination of employment or at the end of the month. And we're going to show her, for her month of termination, as 2B, employee not full-time and did not enroll in MEC. And then in October, November, and December, just for purposes of our what if as marked by the question marks, if she terminated employment and that was the loss of coverage, then the employee was not employed during the month we used 2A. Now, if the employer had not used the monthly measurement period and instead used a look-back measurement year, then we know if this were considered to be the stability period for this employee, that even if she transferred to part-time, we couldn't drop her coverage, because in a stability period you can't drop coverage. For those of you who knew what I was talking about, I hope you'll take the point, and those of you who don't, I was speaking a secret language that was developed just for Form 1095C. We're going to move on to, this is Cathy's enrollment. It says Cathy enrolled in the month of her enrollment. Example 5 is Simon. Okay, this is an example for line 15. Simon's a full-time employee who, instead of electing a taxable opt-out bonus of $100 a month, elected coverage. So this is an employer that, for people who don't elect coverage, they get a $100 bonus. On line 15, the $100 bonus is added to the employee cost of coverage. And so instead of listing our $150, we have to list $250. And here you can see that if Simon made $25,000 a year of W-2 comp like John, this coverage would be unaffordable for him, because our limit for a person with W-2 comp of $25,000 is $197 a month, and here we're over that. I'm just going to say a few words about the transmittal form 1094C, and you'd think this would just be innocuous, just the form used to transmit information, but it has some other, it does more than transmit information. It provides employer information, and it has the certifications for employers that are going to use a safe harbor for reporting. Here's the form. Here's the safe harbor line, line 22. And it lists A, B, C, D, the 4 safe harbors that can apply for reporting purposes on Form 1095C. I'm going to go over these quickly. They're a little obtuse and complicated, but I will try to hit the highlights. Here's the second page of Form 1094C, and you can see it requires in column B a full-time employee count for each large employer member, and the total employee count. So the full-time employee count and the total employee count is column C. And then here's where you list different members if each employer is in a controlled group. Okay, so the first safe harbor is the qualifying offer method. This is what we talked about before. It's a qualifying offer. If the qualifying offer is made in each of the 12 months, and that would be an offer of at least minimum value coverage, contribution for employee-only coverage of no more than 9.5% of the federal poverty level, and offered also to spouses and dependents, then the employee instead of using the regular reporting that we just talked about, the employer can just use the 1A code, and the employer is also allowed to provide a simple narrative statement in lieu of having to provide Form 1095-C to employees. For 2015, there's a special transition rule which allows an employer to use, for those employees who are eligible, the qualifying offer method if it's made to at least 95% of the full-time employee spouses and their spouses and dependents. Then the employer can use the safe harbor even though the coverage is not for all 12 months. So if you had employees going in and out of qualifying offer coverage, if it's offered to at least 95% of the full-time employees, then just for 2015, the employer can use the simplified code of 1A, leave line 15 blank, and use the narrative statement in lieu of providing Form 1095-C to the employee. The narrative statement just has to have the name, address, and EIN of the employer, the contact name for information on an offer of coverage, and the notice that the employee is not eligible for a subsidy. The narrative also has to make reference to publication 974, which explains all this. The next reporting safe harbor is the Section 4988 safe harbor. This is for the group that has more than 50 but fewer than 100 full-time equivalents and is not subject to a penalty for the year, and this lets the IRS know that. The fourth method I'm going to explain is the 98% offer method. It allows employees to report to the IRS without having to differentiate between full-time and part-time employees. It's only usable for those who offer to 98% of employees for all 12 months of at least minimum value, and for coverage that's affordable for any safe harbor. In addition to not having to signify part-time status for line 16, you can skip column B, listing the full-time employee count, and just list the total employee count. So if you use both the qualifying offer transition rule for 2015 and the 98% method together, you can use a simplified code for line 14, you can leave line 15 blank, you can skip identifying part-time employees on line 16, and you can skip column B for full-time employee count and just give the total employee count. The use of these simplified safe harbors, and the reason we're showing them to you, is that if you can use some of these simplifications, then you may minimize the possibility of making errors in using the codes and the other reporting requirements that apply to regular reporters. So with that, I'm going to turn it over to Cameron.
Great, thank you very much. So I'm going to talk a little bit about the penalties for noncompliance. That is, if you do not file the 1095C or 1094C correctly and on time, there are various penalties that will apply, and the first one is the penalty for failure to file a correct information return, which is the form you file with the IRS, and separately there's a penalty for failing to file a correct statement with that's the statement that you send to the employees. And the failure to, each one of these is a separate penalty of $250 per failure, so maximum for each employee could be up to $500. And the penalties can be reduced if the reporting entity corrects and files within 30 days or by August 1st of the reporting year. And then intentional disregard will increase the per return penalty and eliminates the annual cap, which, as we see on this chart on the next slide, is you can see for a failure you have a maximum penalty of $3 million. If it's corrected that within 30 days, that penalty will be reduced to $500,000. By August 1st, it's up a little bit, it'll be 1.5 million. And then there's a de minimis safe harbor where if the penalty can be 0 if you correct by August 1st and the number of returns is less than 10 or 0.5% of the returns required to be filed. And there's also inconsequential errors are not considered failure to file. So for example, if you misspell the word street in the recipient's address, that would be considered inconsequential and it would not be subject to the failure to file penalty. And then,
Cameron, what if they actually misspelled the recipient's last name?
So something of that significance where it's important that information is necessary for identifying the person, that would be consequential, and that would be a significant enough error that if it were not corrected, that you would have to correct it, and if you correct it within 30 days or before August 1st, you could get a reduced penalty, but that absolutely would not fall under the inconsequential errors de minimis exception. And there's also for smaller entities whose receipts are under 5 million, the maximum cap, you can see the per return penalty is the same, but the cap is lower. So it's 1 million for the general failure, and then if you correct within 30 days, it's 175,000, and if you correct by August 1st, it's 500,000. And then I thought it might be helpful just to do a couple examples just to see how the penalties work and how the caps work. So Company A has 1,000 employees, so therefore they qualify as an applicable large employer who has to file 1094C and 1095C. The Company A does not do any of that. They don't file the 1094C and 1095C or send the information statements to the employees. So Company A's potential penalty could be over 500,000, and you can see how that breaks down: 250 for each return that was supposed to be filed, 250 for each information statement that was supposed to be filed, plus 250 for the 1094C, the transmittal. Now, the next one, Company B, has 20,000 employees, and we'll assume it has gross receipts over 5 million. And Company B does not send the forms, and so its potential penalty could be over 6 million. And if you look at the breakdown, it actually could be 5 million for the returns, 5 million for the information statements, but because of the cap, the total exposure would be about 6 million. And then if the entities had under 5 million in gross receipts, that penalty would be further reduced to 1 million. So I guess the big question is, what can you do if you are at this point and thinking that you may not be able to file, get everything in order to file on time and file correctly? I think the main message here is that it's good to start thinking about it now, and that there are a few things that you can do if you don't think you'll be able to file perfectly correct and timely information returns. The first thing you can do is seek an extension. We'll talk about each of these in turn. The second phase is there's a good faith penalty relief that Lisa mentioned in the beginning, only for 2015. And then finally, there may be a reasonable cause exception, which is just the regular statutory penalty relief that Lisa will talk about later. And then finally, consider ways to minimize the penalties. So first thing you could do is file for an extension. And you can file for an automatic 30-day extension for forms filed with the IRS. And you can do that by filing 8809, which is the application for extension of time to file information returns. And for this automatic extension, you don't need any explanation, but you have to be sure to file this 8809 by the date the returns are due to be filed with the IRS. And you can submit them electronically or on paper. So this is just a picture of what the 8809 looks like. If you look down on line 6, you can see over to the far right, there's just a box that you would check for 1094C and 1095C, and then you sign it, and you don't need to do any kind of explanation. For the recipient statements, it's another story. Right now, the information statements are not eligible for the automatic extension. So to request the extension for the recipient statements, you'd have to send a letter that includes the various things you see on the screen, the filer name, filer social, filer TIN, filer address, type of return, a statement that this is going to be for a providing statements to the recipients, and then F is the reason for delay. So that would be some sort of narrative explaining why you cannot file on time. And then the next page just simply has the address. This is the address that's currently in the instructions, though for future years it might be a good idea to just confirm. And I think important to flag for this, for the 30-day extension for recipient statements, is that the IRS has indicated that it's considering how to make this easier for Forms 1095. So we don't know exactly what that might look like, but they are at least acknowledging that there might be something that they could do there to make it a little bit easier to request the extension for the employee statements. So for 2015, as we've talked about, the IRS has said that it will not impose penalties on employers who are making good faith efforts to comply. So what the IRS has said is that, and this is a quote that you can read, and it says, relief is provided from penalties for returns and statements filed and furnished in 2016 to report coverage for 2015 for incorrect or incomplete information reported on the return or statement. So critically, that means you have to actually file something. No relief will be provided if you don't file something. And you must file on time, and you must be able to show good faith efforts to comply. Well, what does that mean? What constitutes good faith efforts? The official guidance in this area is limited. The preamble to the reporting regulations specifically mention Social Security numbers, taxpayer identification numbers, and dates of birth. And the example that's given is that an insurer that makes a reasonable effort to obtain the employer identification number of the employer sponsoring the coverage will not be subject to penalties for a missing or incorrect EIN. So I wanted just to take a second and talk now about TIN solicitation, because reporting of TINs is something that we've heard people have a lot of concern about, and the IRS has very specific rules about how you would ask for TINs, both generally and in the ACA context. You can see in general, the regulations state that a reporting entity must seek the TINs at certain points, and then once you have asked those 3 times, you don't have to ask again. And the IRS has been more specific in the ACA context and has said that the initial solicitation has to be made at the first enrollment, or if you're already enrolled on September 17, 2015, at the next open season. Second solicitation is made a reasonable time thereafter, and a third solicitation is made by the end of the year following the initial solicitation. And so if you ask those 3 times, you don't have to ask again. So in the past, good faith efforts penalty relief has generally been given in the first year of required reporting. It's a facts and circumstance test for reporting errors, missing or obviously incorrect PINs that would be more or less than 9 digits, or a letter instead of a number, and incorrect name and TIN combinations are all types of things that would qualify for fast relief. Things that do not qualify for relief would basically be if you don't file on time, you don't file at all, or you don't file on time. And so I guess the bottom line here would be basically do your best. Be sure to file and do your best, give your best efforts to file accurately. But if you can't, if you can prove good faith, you may be eligible for this good faith penalty relief. If that fails and you're not, for some reason you don't believe you can meet the good faith efforts penalty relief, there's also general statutory penalty relief that I'm going to turn it over now to Lisa to discuss a little more. Lisa?
Thanks, Cameron. So Section 6724 of the Code provides for a waiver of information reporting penalties if the failure to file correct returns or to furnish correct statements was due to reasonable cause and not to willful neglect. So this waiver applies to all information returns, including 1099s, W-2s, and as well the ACA forms. The reasonable cause waiver rules still apply for 2015 if the good faith requirement isn't met. And in fact, these rules may actually be instructive in establishing what is good faith efforts for 2015. However, we believe generally that the IRS is going to be more lenient with respect to good faith than they typically are with respect to reasonable cause. So the reasonable cause is likely to be of greater use beyond 2015. Reasonable cause generally exists if the filer demonstrates two requirements. The first one is that there are either significant mitigating factors or the failure was due to events outside the filer's control. And the second is that the filer acted in a responsible manner both before and after the failure occurred. The existence of mitigating factors is a facts and circumstances determination, but the regulations do provide a couple of examples. The first example is that the filer was not previously required to file the particular type of information return. And then the second one was that the filer has an established history of complying with the reporting requirements in issue. Since 2015 is the first year of mandatory ACA reporting for all filers, these mitigating factors are not likely to be determinative. But for future years, as you start establishing a history of filing, they may become more relevant. Similarly, whether the noncompliance is due to events beyond the filer's control is a facts and circumstances determination. And the regulation again provides some examples. The first one is unavailability of business records. For this one to apply, there has to be a supervening event, such as a fire or other casualty, or the unavoidable absence of the person with sole responsibility for filing. So for example, if the person dies or is subject to a serious illness and is not able to make the filing. This exception usually only applies if it occurs within a short period around the filing deadline, typically a couple weeks before the filing deadline so you're not able to meet it. The second example given in the regulations is undue economic hardship for filing on magnetic media. Since magnetic filing isn't available for Forms 1094 and 1095, this doesn't really apply to the ACA reporting. The third example is actions of the IRS resulting in reliance. This one only applies if the IRS provided erroneous written information to the filer after it was provided with all the relevant facts. This will come into play, for example, if the taxpayer received a private letter ruling or a determination letter from the IRS, basically advice that is taxpayer specific. Since the IRS hasn't been providing taxpayer-specific advice on the ACA reporting requirements yet, but rather has only provided general guidance, this example probably isn't likely to come into play either.
So what about relying on a tax advisor instead of relying on the IRS?
Yeah, actually, the IRS manual does provide some relief here. It's not specifically listed in the regulations, but the manual notes that reasonable cause may apply if the filer contacted a tax advisor that was competent on the specific tax matter, furnished all the necessary and relevant information, and then was incorrectly advised that the filing of a return was not required. That's the example that's given in the manual. Presumably, advice that goes beyond advice that a form is not required would also be subject to this exception as well. One of the other examples that's listed in the regulations is actions of an agent. The filer here has to show that it used reasonable business judgment in contracting with the agent in the first place for the preparation of the forms and statements, and also provided the agent with all the relevant information. The filer also has to establish that the agent had reasonable cause for the failure. This is basically a dual determination. You have to have reasonable cause for relying on the agent, and the agent has to have reasonable cause for the failure. So they have to go through all the requirements for mitigating factors or events beyond the control, as well as the taxpayer. And the last example that's given in the regulations is actions of the payee. This exception would apply if the employee or the insured didn't provide the correct information to the filer. The filer has to show that it made reasonable efforts to obtain the necessary information. And as Cameron mentioned, specific rules are provided in the context of TIN solicitations. Now, it's important to keep in mind that the regulations are more than 2 decades old and don't necessarily contemplate the complexities of the modern information technology systems. The ACA reporting presents considerable complexities. The information is often resident in different systems. Clients have information in the HR system, in the tax system, in the payroll system, and those systems often don't talk to one another. So pulling the information from the various systems can be quite challenging, and so it's one reason why the IRS has provided some relief for good faith filing in 2015. The IRS manual also provides a few additional examples that involve electronic media to try to update the regulations a little bit, including major hardware or software problems, a situation where the taxpayer may have contacted 2 or more service providers, but they wouldn't contract to prepare the information returns without contracting for a range of other data processing functions. So basically, if the service provider was going to hold you hostage and say you have to contract for all your data service with us in order for us to do these returns. And then the third one given in the manual is that the taxpayer is geographically remote and couldn't arrange for electronic media processing. Once the filer demonstrates either mitigating factors or events beyond the filer's control, the filer has to show that it acted in a responsible manner. That is, that it exercised the standard of care that a reasonably prudent person would use in the course of business to determine its filing obligations. And it has to show that it acted responsibly both before and after the failure. The filer also has to take significant steps to avoid or mitigate the failure, such as requesting appropriate extensions, like Cameron mentioned, attempting to prevent foreseeable failures, and acting to remove the cause of a failure once it's occurred, and then rectifying the failure as promptly as possible. A correction is typically considered prompt if it's made within 30 days of discovering the failure or removing its cause. And again, the IRS manual provides some additional guidance in this area, specifically including additional facts that the IRS might consider to determine whether the taxpayer acted responsibly. Questions that it looks at specifically are, does the length of time between the event and the filing date negate the event's effect? In other words, did you wait too long to fix it? Does the continued operation of the business after the event negate the event's effect? Was the penalty the result of carelessness or an honest mistake? If a third person is being blamed for the failure, what is the relationship of that third person? For example, is it an employee or an agent of the taxpayer? Is it a lawyer or accountant or another trusted advisor of the taxpayer? Does the filer have a history of incurring the same penalty? In this case, the IRS, if there's a history of incurring the same penalty, the IRS might consider intentional disregard penalty if there's a pattern. And could the filer have requested an extension or filed an amended return? So what if you don't file on time? So the good faith relief isn't available for 2015, and you can't otherwise establish reasonable cause. Here, I think the best thing you can do is try to minimize your penalties. First and foremost, try to buy time. File for an extension, and then try to get the information together and do the best you can in filing a correct return. Another thing is to reduce the penalty amount by filing as soon as possible after the due date. As Cameron mentioned, the penalty is reduced to $50 a return if the correction is made within 30 days, and $100 per return if it's made after 30 days but before August 1st. Let's look at a quick example. This is actually the example that Cameron looked at earlier. Company A can't file on time. So as we discussed before, Company A could be facing penalties of over $500,000. If Company A believes it can be ready within 30 days of the filing due date, then it should obtain an automatic extension for the filings with the IRS. And then when it does file and send the information returns, its penalties will be reduced to $100,000. There would be no penalty actually for the information returns, and a reduced penalty for sending the information statements by August 1st. That's how you get to the $100,000. Now, if the IRS doesn't receive the form before the employee files his return, claiming that he had insurance coverage, you should be aware that the IRS system may spit out a letter to the employee indicating that he may be subject to the individual responsibility provision. Likewise, if an employee doesn't receive his statement, he may have trouble filling out his return. So even if you can't get the employee statements out on time, you may want to try to communicate with employees in time so that they can file their tax returns. These are just a couple of things that you should be aware of. These are the consequences that you should look at if you don't file on time.
So Lisa, what if I do my best to fill out my forms and somewhere I put a wrong code, or I don't have all of the dependents listed, or I make some mistake? Do I have to go through all this that you're talking about?
Well, for 2015, chances are if you do your best to get the correct information and you still make mistakes, that the IRS is going to let that go with a good faith filing. Going forward, if you can show that you had reasonable cause for the mistake, generally what you want to do as soon as you discover the mistake, you want to try to correct it. And the sooner you correct it, the lower that your penalty will be. Unless you had, a reasonable cause exception, somehow the system malfunctioned and it was due to events beyond your control or something like that, that might provide a reasonable cause exception. Okay, the next slide. So as we've mentioned, the determination of whether the filer acted in good faith or with reasonable cause are factual determinations, and the burden of demonstrating these things are on the filer. So you should make sure that you document your efforts to comply with the reporting requirements. Summarize overall, the new reporting requirements are obviously quite complicated. Joni took you through a number of examples that illustrate that point pretty clearly. But relief from errors is available, particularly in the first year. So for 2015, you have to file on time in order to take advantage of that relief, request an extension if you need to, and just do your best to provide the correct information. The IRS is likely to be fairly lenient in 2015, just trying to get people to file and do their best. And if the standard for good faith isn't met, you can still satisfy the general reasonable cause penalty relief. But the factors that must be established are likely going to be more difficult than it is to satisfy the good faith efforts. And so with that, I think we do have some time for questions and answers, and I believe we've gotten a couple over the system. So I will open it up for questions now.
Well, I had a question. Oh, go ahead, Jenny.
I'll take that first question. Somebody asked whether the first 80 employees are exempt in 2015 from the A penalty. They're not quite exempt from the A penalty, but you're close. In 2015, you still have to offer coverage to 70% of your full-time employees to avoid that penalty. Assuming you don't offer coverage to that requisite 70% and the penalty applies, then the relief that you're referring to is that the penalty is only going to apply to your full-time employees in excess of 80. So by that, let's say you have 500 full-time employees, you failed to offer 70%, the penalty is going to apply to 420 employees. We're not going to count those first 80 full-time employees. And after 2015, that number drops to 30, and then we begin to count employees in excess of 30. Joni, do you want to take the next question?
Okay, I had a question. Do we need to fill out a 1095 for all employees in 2015 or just the full-time employees? If you have part-time employees who you don't expect to go full-time and are never going to be eligible for the plan because they're part-time, you don't need to file for them. But if you have somebody who starts out full-time or is full-time for some months, then you may want to explain the months that they weren't covered by using the codes for their going part-time or being part-time. Got another question. What are the standards for companies with less than 50? If we could just go back to our chart for a minute. That was slide. I can't remember what slide. If you have a self-insured plan, oh, here it is, slide 42. For employers with fewer than 50, if you have insured plans, then the insurer is going to file and the employer does not have to file. But here's the trick part. If the employer has fewer than 50 full-time equivalents and the plan is self-insured, the employer has to file on Form 1095B, which is the coverage provider form. That's just a little trick in the rule. Just reading through the questions here. If you don't offer coverage, let's see, between 40 and 50, between 50 and 99 full-time equivalents, and you don't offer coverage, there's no employer-provided coverage, so there's no Form 1095C.
Joni, could you read the question so that folks know what you're answering?
Yeah, and this maybe we'll call this person offline and talk about the particular facts that are here in the question, but basically the question is, if we are an employer between 50 and 99 full-time employees that did not offer coverage, does slide 58 show our reporting requirement? I think we're going to call offline for this. This is one of the alternative reporting methods, so we'll get in touch with you offline on this one. Do we have any more questions? Lisa, I've heard the IRS say that they're not going to be picky this year. Is there any point on which they're going to be picky, or can we just sort of wing it?
It's hard to say at this point how particular they'll be. The problem that you run into is that the information reporting and administration of all of these provisions and penalties are interlinked. And so to the extent that you don't get the information reporting right, your employees are going to get pinged with letters from the IRS. And most employers that we've talked to don't really want their employees getting letters from the IRS. And so they're trying to do their best to comply. So in some cases, it's not how picky the IRS will be, but how many of your employees get letters from the IRS. And so there's kind of competing things here. I think probably for the first couple of years, the IRS will generally be pretty reasonable. And as people's systems, get up to speed, and then the expectations will probably be more significant. We do know that 2015 is, they're going to be really reasonable and just, take any good faith efforts. But, going forward, you're going to need to be a little bit more vigilant about trying to get your systems in place and, generating the correct information. But there's no way to tell exactly how strict the IRS will be in the, in the next couple of years.
I've got a question. When making an offer, I send a letter to the employee listing the cost for the employee, employee plus C, employee plus S, and family. Does this qualify as offering to dependents? I assume this is the communication letter where you list the premium amounts for the different kinds of coverage you have. So if you have coverage that is listing employee plus C, which I assume is employee plus children, employee plus S, which is employee plus spouse, I guess, and family, then it sounds like your plan does offer to dependents and spouse. So if I have those abbreviations right, I would say yes. When you're listing, so that would be, for our line 14 code, that would be our 1E, I think. But when you're listing on line 15, the employee portion or the employee cost of the premium, you're only going to list the premium for self-only coverage. So you'd be listing the premium cost, the portion that the employee is responsible for, only for your category employee, and not listing the premiums for those other categories.
All right, so with that, we want to conclude this program and thank Steptoe for sharing their expertise on this issue, along with thank our audience for their great questions. Please take a moment to fill out the exit survey so we can continue to bring you quality programming in the future. This concludes the webinar.